Here, okay, guys. So we start and let me move to this part here. So there's going to be some logistics moving on around the first class, but it's going to be cool. Do you have any questions before we start, guys, in the class with the class? No. The other thing that we do, guys, is that we don't stop. Okay, so I prefer to move until perhaps 2 hours and a half, 2 hours 40 minutes. It depends on how we move. Instead of having a break, normally my colleagues take a 15-20 minutes break in between, but I don't do that. I prefer to move, and also for our colleagues in Africa, it's much better to finish earlier. Okay. Remember, next class 5 p.m. we start. Got it. So let's start, guys, with a brief description of what we are going to be doing. Okay, just a brief description of finance and the environment of finance. So let's start talking about a corporation, and I will focus on the work of a CFO. Okay, the Chief Financial Officer. That's what I will focus all my attention in this class. But in any case, we need to understand how a corporation works. So we have normally the top element of a corporation is the board of directors. Right? And below these guys, we basically have all the officers. Okay, being the main officer, at least in USA, what is called the CEO. And below the CEO, depending on the type of organization you have, guys, you're going to have a bunch of other officers, but the one that I will focus is the CFO. Okay, and who's the CFO? Basically, is the guy that manages the finances of a corporation. Okay, we're going to see what he does in time. We're going to put this into perspective. Now, the CFO normally has 2 guys that work with him. Very important guys. The treasurer, so treasury, and the controller. Okay, so my treasury, guys, is the one that basically takes care about the cash management. It has to do with check credit management. He also does a couple of roles that are really important: capital expenditure, and something that is called financial planning. This is normally how the structure in the treasury works. Okay, so you have someone that is always looking at the cash, credit, capital expenditure, medium term, long term, and financial planning. Okay, so what projects we're going to do, how we're going to finance that, etc. And the controller goes more into the world of we'll do this here, more into the world of taxes. So this is crucial. Do you agree? Okay, so taxes, guys, is something that the corporations pay special attention. So you need to basically optimize taxation. And basically, your point of the equation in corporations is costs. I need to be sure what is the cost of production. I need to be sure about, allocation of cost among different divisions in the corporation. And then we have, of course, here we have financial accounting or accounting. And more now than before, guys, information systems. How the financial information links with sales, with marketing, with production, etc. So this is what it does. Yeah, hopefully I'm not forgetting anything, but yeah, this is basically the role of the CFO. Or the structure of a corporation under the CFO. Now, guys, what is the role of a CFO or in general about the financial function here? So what is the role of these guys? Always, guys, these guys need to check about 2 things. Okay. They always take a look to 2 things. One, that is a short term. And of course, long term. Got it? So these guys are always looking for what we're going to do now. And also the long term, I will invest in new factories, new machineries. They need to have this in their mind. Okay, and just by thinking the short and the long term, what they need to be thinking, guys, is about how do we finance. Okay, how do I get money for the short term? This is crucial. If I want to survive in the long term, I need to have money now, right? Working capital, for example. But also, if I want to grow, I need to be thinking about the long term. How do I acquire new machinery? How do I acquire new technology that allows me to produce more and more efficiently? Okay, so that's the mindset of the CFO, is always looking for financing. And now, who inputs this information? Basically, sales, production, marketing. So these are the guys that input information to the CFO, discussion with the CFO, and the decisions are made together. Make sense? Okay, and now the CFO, guys, is also responsible for understanding the corporation. And how do we understand the corporation from the perspective of finance? Well, we have the financial statements. Have you heard about the balance sheet? And then this is cool because it's going to allow me to start talking about the class. So when we talk about financial statements, at this point, I just want to do gross, okay? I don't want to go into the details. But when I'm talking about financial statements, guys, I'm talking about the balance sheet. Okay. So this is simply a picture in time of a corporation. Is a financial position of a corporation. So now, and we can divide this basically in short-term assets. We'll do this in gross, okay? And long-term assets. Okay, so here you have cash, inventories, investments. Here you have machinery, buildings, land, okay? The goodwill is also here. And also, this is my asset side of the equation. And in this side of the equation, what I have is normally liabilities. Of course, liabilities also short-term liabilities and long-term liabilities. So these are called my liabilities. So let's call this L. And what is this remaining part here? What is known as a shareholder's equity, correct? So let's call this E. So what is interesting, guys, is that the accounting is an identity. So it's not like econometrics, guys. Those that do econometrics, remember when you have the linear regression, any other type of model, we always add an error. Do you agree? Okay. In accounting, we don't have an error. Okay? We cannot have an error because we have a balance. It should be balanced. Okay. So that's why the assets is always equal to liabilities plus equity. And this is going to be our main equation, guys, in time. Right? So we are going to focus on this main equation. It's going to help us a lot in understanding accounting. Now, what is the role of the finance CFO, guys? Not only take a look to these numbers, okay? Of course, we're going to see how to analyze this one here. We're going to do ratio analysis. We're going to do sensitivity analysis. We're going to do a bunch of things. But the first part of the class, guys, is going to focus on the following. What is the payment of debt? When you get $100 and you need to pay $100 back, you don't only pay $100 back, do you agree? You pay $100 plus what? What is the payment of the liabilities? Someone?
Interest?
Interests. So this is the first part of the class, guys. We're going to understand how interests work. Okay, and interests are going to be basically related to short-term liabilities and long-term liabilities. Short-term liabilities, for example, commercial papers. And long-term liabilities, for example, bonds. Okay? So that's why we're going to understand first interest, type of interest, how they move, the tricks that we can do with interest, and then we're going to start moving about short-term and long-term interest or liabilities and the interest of them. And what is the payment of shareholders' equities? If you invest in a corporation, how do you expect to get your money?
Return yield.
Yeah, sorry. Dividends. Yes, yes. Someone mentioned capital gains. Yes, that's correct. Okay, we're gonna talk about also capital gains, but in general, guys, we're going to be talking about dividends. Okay, so the payments for you investing in equity of a corporation is called dividends, and for you investing or lending money is going to be called interest. Make sense? Now, which one do you think, guys, should be larger, dividends or interests? In general, by logic.
Dividends.
And why?
Because interest is basically taking away from the corporation, whereas that dividends, it's increasing the value of your value of your investment, basically.
Okay, and tell me
the
one thing.
return on your investment.
Is a return of your investments, yes. But remember that the main cause of interest and dividends being dividends larger than interest is related to one general rule, guys, that exists, or theory that exists in finance, okay, that's always satisfied. The higher the risk, what happens with the higher the what? So if you are going to accept more risk, what you are going to be requesting? More returns, okay? Yes or no? Otherwise, you don't do it. You should be crazy if I offer you less risk, more risk and less return. So you're crazy. No. So the relationship, guys, between interest and dividends, being dividends larger than interest, is driven basically by the risk. Okay. If we collapse, if the corporation collapses, bankruptcy, okay, who's going to receive first the payments for whatever is left from the corporation? The debtors, the creditors. Sorry, these guys. Okay? If we collapse, if the corporation collapses, we are going to have some assets, hopefully, we don't know, perhaps everything disappears, but in any case, what is left from the corporation is first paid to the creditors. And what is left after paying everyone, the government, the employees, plus the debtors, is left for the investors. Got it? So remember, this is a crucial concept, guys, that we always miss from, we don't take into perspective. When I talk with politicians about this stuff, it drives me nuts. Why? What I'm talking is the following. When you say, you know what, why dividends are so high, why the profits are so high of corporations? Well, because they are taking some risk, okay? And remember, guys, if you in time do a business, you're gonna feel the pressure of producing, because if you don't produce, guys, you simply collapse. And collapsing for you implies that you're going to lose your money, your time, your efforts, everything. Okay? So there is a concept here that is crucial. Dividends is a compensation for basically taking risk. Got it? There are a lot of discussions we're going to do once we start understanding interest, dividends, and we're going to go more into the economic policy. But understand that it is risk, basically the main. So debt is less risky than equity. Okay? And so how do we understand this? Debt is less risky than dividends. Okay, so remember, guys, a corporation, okay, it's a contingent claim. So this looks like an option, okay? What is a contingent claim? Its value depends on how well the corporation performs. For example, if we have the debt here, okay, debt instruments, and then we have investments, equity here. And I will do in my vertical axis the payoffs. In both cases, the payoffs. And then imagine, guys, that I have a level D of debt. Got it? So these are profits, corporation profits. And D, my payoff is going to be D plus I, of course, here. So is my debt plus my interest. And I will have here D plus I too. And then what happens, the logic is very simple. If the corporation starts producing zero, okay, no one earns nothing, do you agree? Zero, it is here. Now, if the corporation starts producing the first dollar, second dollar, third dollar, fourth dollar, et cetera, et cetera, et cetera, et cetera, boom. This money here, guys, if the corporation just produced D in dollars, sorry, D plus I, so it should be D plus I. If I produce just D plus I, what do I get as a business, as a businessman or woman? Nothing. Do you agree, guys? And then, but what happens with debt? As soon as that the risk is limited and they have priority, after we pay them the debt plus the interest, after they don't receive anything else. Okay, we simply pay you. You give me 100, you 10%, I pay you 110, you receive nothing more because you're just giving me debt. You have priority, but because of that priority, your payoff is limited to the interest rates. Okay. Of course, I'm talking about the interest rates that are fixed, but interest rate can also be, variable. But in any case, this is the idea. Now, what happens with the payoff of equity, guys? Well, if you're the owner, you receive nothing. So let me write this perhaps in a different color. You receive nothing until you pay all your debt. And then what happens once you have paid all your debt? So your corporation is growing, your clients love your products, and then you continue hiring people, new technology, improving on efficiency, etc. Productivity goes up, etc. So what happens with you? The sky is the limit. Make sense? Now, indeed, guys, financial markets work are not as beautiful as this one here because we have a third actor. And it is important. The third actor is also important. But let me put this in a different perspective. Where do we get the money? In general, guys, we have something that are called financial markets. Okay? It's the markets of money. Okay? I need resources. Where do I go? Financial markets. Oh, sorry. Let me do this in a different way. Let's move this financial market somewhere here. So let's say here financial markets. Okay. And in financial markets, what do I get? I get basically two types of products. I have credits, or what I call debt, or I have investments, what we are calling equity. You agree? So that's what you find in the market. So if you go to a bank and you ask for debt for a loan, okay, you get money for a loan. And if you go to an angel or a venture capitalist, you get investment, so you get equity. Now, what is important here is what you have is a corporation. And the corporation has what? What the corporation offers to the financial markets? Well, basically assets. And what is an asset, guys? What is an asset? It's simply something, can include individuals, okay? Can include machinery, inventories, ideas, everything. So what these assets produce is what they do is they produce value. Okay, so what do we understand by value? Okay. Value, guys, is simply, if I buy something 100, I add some value added, I change, I modify the color, I create something new, or something that the people really like. And then I'm able to sell by more than 100. So this is what is called value. Right? So what corporations do, guys, and CFO, this is the role of CFOs. What they do is they analyze their assets, they understand what they have, they understand the projections, they understand their ideas. They know how they can do this together with production, sales, marketing, etc., and they produce value, okay? And when they produce, or at least in paper, or they have already history producing debt, they go to the financial markets, and what they do is they get funding, okay? Either debt or investment. When they get this funding, guys, what they do is they produce value, and this value is used for what? Well, to pay debt plus interest. Do you agree? With the value I'm producing, I should be able to pay the debt plus interest. And I should also be able to pay my dividends. What else? So the value that I created, okay, I pay dividends to my investors, debt plus interest to my creditors. What else? What else? What other uses of the money produced by a corporation? One, guys, is that you reinvest. Yes or not? So you can say, you know what, this money, I will not, you cannot say, I will not pay you debt. I will not pay the debt. You cannot say that. But what you can argue with the board of directors that represent the owners, you can say, you know what, guys, for the first 5 years, no dividends. So let's put all our money to make the corporation grow. Make sense? Okay, what else? Value produces something to pay debt, dividends, and reinvest. But we're missing someone here. Someone that is very important in the equation. Who's this guy? Who's this guy that we are forgetting here in the picture?
The treasurer?
Exactly. So the government in general. Taxes. Taxes, guys. And that's a complete picture. You see, in finance, we take a look to, we need to understand perfectly what is value, how do we create value, how do we get the money, can be short-term, long-term, in order to create value. And we need to be sure that we're able to pay the debt plus interest, we're able to pay our investors dividends, we're able to grow, reinvest, if there is some money left. But we cannot forget the government. We need to pay taxes. Make sense to you? Now, guys, let's talk a little about taxes. So what is the impact of taxes? I will just pay attention to the equity. What is the impact of taxes, guys? What do you think? How do you think taxes influence my red line?
It erodes away value.
Yeah, so basically, guys, for this part here, if you don't produce anything, you don't receive anything, right? Governments don't receive anything here. Let me admit someone here. You agree? So if you're losing money, you don't produce anything. However, if the corporation starts growing, what do? You start taking a piece of the you start taking a piece of the profits. Do you agree? So technically, guys, what it does is simply moves my profits a little down. Okay, how down? It depends on the tax rate. So if we talk about 10%, okay, perhaps it's here. If we talk about 30%, perhaps it's here. If we talk about 100%, so basically we have everything here. Do you agree? Okay, so what is the most efficient taxation? Well, there's huge discussion here. It's 20%, it's 30%, 15%, it's 10%, 5%. It is huge discussion. But the idea, guys, is that two things. Taxes reduces profitability, okay? But also, what is interesting, guys, the more profitable the corporations, the more the taxes are collected. Make sense? So it is you know, I don't want to destroy corporations because I will not be able to tax anyone. Do you understand that that's the system? That's the idea, the basic idea of corporations. Now, your question is what the governments do with taxes. Okay, so we don't talk about that in this class. So for those of you that are an iPad guys, you have a fantastic class on, you know, on the political economics of taxes. Okay? How do you use it? What is first? Education, health. or any other priority. So that's different. What is the adequate taxation? So that's a different question. So in my case, guys, in this class, I will assume taxes as given. Okay, 20%, 21% in USA, perhaps it's going up to 28 or 25. It's in negotiations currently. But that's the basic idea, right? So you as a, so this page here, guys, is a very interesting summary of what a CFO does, or what a CFO or anyone related to a corporation that is taking a look to the financial side of the equation is going to be looking at. In this class, we're going to learn a lot about interest and, of course, dividends. These are names. The techniques are exactly the same, right? We are going to understand how to make strategic decisions once we understand all these techniques, etc. Make sense to everyone? Questions at this point? Questions, guys? No? Okay, perfect. So let me move. Okay, so now let's go into a little more mathematics. So what is finance, guys? What is finance for you? Any ideas? What is finance? Why do you think finance is important to study and understand? Guys, any ideas?
I think finance is a flow of cash.
Yeah, that's a good point. It's a flow of cash. Yes. So in your definition, you are talking, when we talk about flows, guys, we talk necessarily about time. Right? It's not a stock, it's not a today and that we forget about the past and the present. It's a flow. So it implies today, tomorrow, in a year, 10 years. So time. Okay, perfect. And so basically, guys, the best definition I use for finance, guys, is simply the exchange of money in two different points of time. That's it. Okay, simply if you have money here and then you have money here and then you see that there is time here, what is finance is simply the study of how money is transferred from time 0 to time t plus n. Right? Now, this looks easy, right? Come on, so easy. Finance is simply analyzing what is the value of money in the future based on the value today. However, guys, the problem is that we are not in a linear world. You agree? So if I tell you guys, what do you think is going to be the value of $1 today? What is the value of $1 today in 1 year? Someone can give me an idea. So I'm telling you guys, you have $1 here, and you're gonna put your $1 in the future. So what do you think is going to be the value of $1 in 1 year? Someone.
$1.25.
$1.25, yeah, why not? Another one? Just give me numbers, whatever number you can imagine. See yourself in your country and say, you know what do you think is going to be the value of $1?
$1.50.
Wow. Okay, so now, do you understand, guys? Finance is simply talking about the value of money in different periods of time. However, what happens when we talk about different periods of time, immediately when we talk about time dimension, we enter into a dimension of uncertainty. You agree? We don't know exactly, we know that we are at 1, but we really don't know where we're going to finish in a year. Do you agree, guys? That's the beauty about finance. There is a lot of challenges. How do we compute what is going to be my expected value in 1 year? Well, it depends on a bunch of things. It depends on the macroeconomic development of your country. It depends on inflation that is affected by trade, that is affected by your balance of payments, that is affected by strikes, that is affected by the price of copper, that is affected by the price of gold, that is affected by the financial markets going good or bad. Do you see that? That's finance. So even though the definition is very simple, simply exchanges of money in time, what involves an understanding finance, guys, is huge. And that's why it's very challenging and it's very interesting to study, guys. If you want to study more about finance, do it. There's a lot of things to learn and you're never going to stop learning. Make sense to everyone, guys? So what is finance? My definition is simply that. It's the exchange of money in time. This involves risk, uncertainty, and so that's why it's very fun. Now, guys, we're going to talk about something that is called the equation of equivalence. Okay, and this concept is crucial and it's going to distinguish you talking in financial terms than talking in accounting terms. Okay? Now, what is the equation of equivalence, guys? It's simply the present value of cash flow 1, and we'll talk about what is cash flow 1, equals the present value of cash flow 2. So this F1 and F2 are simply cash flows. I will talk in a minute what is a cash flow. So this implies, guys, that if you have two monies in different points in time, okay, 1 year and 5 years, and if you take the present value of these 5 years and you move it to 1 year, and these two present values are equal, so these two monies are equivalent. So equivalent means, guys, that you can do whatever you want. You can sum, you can subtract, you can divide, you can do whatever, right? But the condition is this one here. Only if you have equivalence, you can do these operations. If you don't have equivalences, so this implies that you cannot sum, you cannot rest, you cannot do anything with these sums, with these numbers, right? This is a huge difference with accounting. So remember, in accounting, guys, if we have, for example, if I have at time 0, I have $100, and at time 1, so let's say after 1 year, I have 110. Do you agree? So what is my profit? What is my profit, guys? In accounting terms, yeah, well, it's very simple. 10. Do you agree? Guys, do you agree or not?
Yeah.
I need to hear from you guys, otherwise I don't know if you're following.
Yes.
Okay, perfect. So this implies simply that you don't care about time. What you care is about the absolute value of money, and then you simply subtract that, and then you get your accounting term. Okay, 10. My profit is 10. Now, what do you think about that in terms of finance, guys? In terms of finance, there is something more that you need to know. If I tell you, so just put yourself in the following case, guys. I tell you, guys, if you give me 100, for sure, in a year, you're going to get 110, for sure, okay? Forget about risk. So there is no, these multiple paths. You have, for sure, 110. Do you give me this 100, yes or no? So you're making a profit of 10, yes or not?
It depends how long you're going to keep it.
Yeah, no, let's assume that there is nothing here and then your 110 is going to be here. It depends on what. Yes, there is a conditional here that makes you, is this indeed 110, yes or no? And here comes your definition that you need to be very careful. These ones here, guys, these 100 and 110 in finance are called nominal terms. You agree? So these are dollar values, but they are nominal. However, in finance, guys, we care a lot about something that is called time value of money. Okay, and normally the time value of money, guys, we're going to be assuming that we move it with, we consider this one based on inflation. Okay, and I will put here relevant inflation, and you're going to understand this later. So what I'm talking, when we talk about inflation, guys, I'm not necessarily talking about CPI, okay? When we have in 3 or 4 classes, we are going to discuss completely about inflation. I will show you that not necessarily CPI is a good number for you. It depends on what you do. Okay, if you are in an airline industry, for example, what is the number that you need to focus always? You don't care about food, do you agree? The CPI has food, clothing, etc. What do you care about if you're in the airline industry? What is your factor that determines inflation in your industry?
Fuel price, oil price.
Exactly, oil price, fuel price. That's 60% more or less of the cost structure of the airline. Between 50 and 60% of the airline industry cost structure is given by fuel oil. Okay? So that's why I'm saying relevant inflation. That's what I mean. It's not simply using CPI because you want to use CPI. Of course, it gives you a reference, but not necessarily the correct one for the business you're going to be doing. Okay, so indeed, guys, what we are going to be talking is, okay, nominal is cool, but in finance, we don't necessarily talk about nominal. We talk about real terms. So what is real terms? Simply means I need to incorporate the value of money. And if I assume that the value of money is inflation, and assume here scenario A, what if inflation is 10%? What if inflation is 20%? What if inflation is 5%? Okay. If this is true, guys, the value of $100 today, just the value of $100, so that the purchasing power of $100, if you have an inflation of 10%, is going to be 110. Do you agree? So do you make money or not? Nominal, yeah, my profit is 10. But in real terms, I'm making 0. Make sense to you? Now, if it's 20%, so this implies that this 100, the value in time of this 100 should be 120. Okay? Otherwise, you're losing money. If this 110, guys, is making you lose money. And finally, guys, what if it's 5%? Of course, this 100 in the future should be worth 105. And then in that case, yeah, you have a real $5 profit. Make sense to everyone? Okay, so careful that in finance we care about real numbers. Okay, nominal are nominal. Okay, nominal are real if inflation is equal to 0, etc. And also, guys, take a look to how important is inflation and why we in USA are always worried about inflation. Not only USA, everywhere in the world. So we don't want to have these high inflation rates because your money, your real value of money, simply starts depreciates. Do you agree? So you need, if you want to buy, imagine with 100 pesos, you buy 1 kilo of sugar. In a year, you need 120 to buy 1 kilo of sugar. Do you agree with that? That's the issue with inflation, and that's why inflation is so criminal. Why? Because it normally affects, guys, if you have a lot of money, if you make tons of money, inflation, 20% inflation, of course it's gonna damage you, but it's not going to damage you a lot or as much as someone that is making really, really not enough money. Right? So that's why inflation, guys, that's why central banks have as a mindset, inflation. We need to keep inflation and higher jobs. Okay, so that's normally the mandates of central bankers, because that's crucial. That the inflation really affects the population of less resources, with less resources. Make sense to everyone? Okay, this is a question of equivalence, guys. So this implies that you cannot sum this 110 with this 100. You need to make them first equivalent. Okay, how do you make them equivalent? Okay, move the 110 into the present, or move the 100 into the future. In that case, you can sum and subtract if you want, but they need to be in the same time. They need to be equivalent equations. Right? You cannot do like an accountant in finance. This is wrong, unless you're assuming that inflation is 0. Unless you're assuming indeed that time value of money is 0. Come on, doesn't make sense. Make sense? Okay, so now I was talking to you, I was telling you guys, we talk about cash flows, and we're going to be working all the time with cash flows. What is a cash flow? Okay, let's define cash flows. The elements of a cash flow, guys, the cash flow can look like this. This is out money. You have in, an outflow, an inflow. Then what is this dimension here? You have time, and there is, so this is inflow, outflow, time, and there is one variable here that is not considered directly here, is my I. What is my I?
Interest.
Interest rate. Okay. So my I, guys, is my interest rate. And what is I? What is the technical definition of I? Is the rate that makes the equation equivalent. Okay, is a rate that makes cash flows equivalent, to be equivalent. Okay, so we're going to discuss this in a minute. So these are the elements of a cash flow, guys. Always we want to have out, in. Of course, we can have many outs, many ins, etc. Time and the interest rate. Now, there are two things. This is first you put the money and then you receive money. So this one here is called an investment cash flow. Do you understand why? In an investment, guys, you put the money first, then you work hard, and then you get your money out. So this is a cash flow that represents an investment. What is a cash flow that represents financing? You receive money first, and then in time you need to pay it. Okay, it's like a mortgage or a car or whatever, or a loan for buying machinery. So this one here is called financing. Questions? No questions? It's clear up to now? No questions, guys? So we can continue? Okay, perfect. Let me save this one here. Okay, so now let's go to something that is, of course, it's obvious. But as obvious as it is, I don't know why so many people make mistakes here. Interest, we'll call this I, caps I, versus interest rate. I will call this I. Okay, so let's do one cash flow. What type of cash flow is this one here? Investment or financing?
Investment.
Investment. Okay, perfect. So what is the interest here? So I will call this one here CF, and I will call this one here C0. So the interest, guys, is simply the future value minus the present value. Agree? So in my example, this is going to be equal to 110 minus 100. So this is my interest. And what is my interest rate? It's simply CF, that the common way of defining interest rate is future minus present divided by present. Agree? The common way we define return. Okay, so what is my interest rate? Of course, this one here is I over C0. So in my example, it's going to be 110 minus 100 over 100. So this is equal to 10%. Make sense? And we're going to do a lot of tricks here, guys, with interest rates, etc. Now, what types of interest interest rate do we have? Well, type of interest rate. How many types of interest rate? We have basically two. And we're going to discover, we're going to describe, we're going to work with them. So we have the simple interest rate. What is crucial about the simple interest rate, guys, no interest over interest. Okay, so if you deposit $100 today, the interests are always going to be computed only on the $100. Okay, that's the simple interest rate. And of course, the compounding interest rate and what is crucial that you need to know from here, guys, is interest over interest. So if you, in between if you deposit 100, then you have 110, the new interest is going to be computed on 110, etc. And then it starts compounding. Okay, so the simple interest rate, guys, we are going to use simply multiplication and divisions. That's all. With the compounding, guys, we're going to use basically exponential or logarithm or logs. It's extremely simple. You're going to see. Just give me 1 second. I will bring some water. 1 second. Okay, guys. Okay, so questions up to now. So we're gonna, during this class, I think we're gonna do A and B, and we're gonna see how they relate to each other. Okay, I think we're gonna be able to do that. Okay, so let's talk about simple interest rate. So how simple interest rate works in a very simple, easy way. So let's take a look to, I will do a cash flow n periods. So I have 0, 1, 2, 3, and this moves to the future. Okay, so if you have C0 here, so my idea is, my objective is to find what is my future value. And then assume my simple interest rate is going to be IS per period. So when I use S, it's going to be simple per period. So this implies that my simple is here, my simple is here, my simple is here, and the same simple is here. Right? So what is going to be the interest that I will make between here and here? So I is going to be equal to what? C0 times IS, do you agree? If it's 5%, this is 100. So simply I will make 5 per period. Agree? Now, what is going to be the interest for the second period? It's also going to be C0 I times S. And if I do this one here, it's always going to be, because remember, there is no interest over interest. So this implies that my base is always C0. And if I do this n times, this is also going to be, the interest is going to be, so this is I, this is I. My interest is also going to be this one here. So your CF is going to be equal to what? My initial capital, C0, plus what? C0 times IS plus C0 times IS plus C0 times IS. Do you agree? How many times this one repeats? N times. So basically CF is going to be equal to C0 plus N times C0 IS. And finally, guys, I have my formula. It's going to be C0 1 plus N times IS. Got it? Now you can generalize this one here, guys. So let's assume that you have IS1, you have IS2, you say ISK, so that you have different interest rates. And this one here happens N1 times, this one happens N2 times, this one happens NK times. So in general, guys, your formula is going to be, the future value is going to be equal to C0, 1 plus N1 IS1 plus N2 IS2 plus NK ISK. We're going to do exercises so you will understand how easy this works. And so this is my generic formula. What is crucial, guys, and remember, interests don't pay interests. So always your principal is always going to be C0, the one that you put in here. Okay, copy, and then we do a couple of exercises to be sure. Do you have questions? Anyone has have questions? It's clear? So let's do exercises, and then you are going to start understanding how this works. No questions, I can move? Okay. So examples. Okay, so let's have this cash flow. You have 100. And you want to know what is my CF if my IS equals 1% per period. Okay, so you tell me, guys, what is my, please start working on this. So we have 5 minutes to solve all of these ones here. All of them are going to be interest simples, okay? Ready, guys? Ready, guys? One more minute and then we continue. Okay, so the first one, someone has an answer? Someone? What is the future value of $100 deposited at a simple interest rate of 1% per period for 5 months, 5 periods? Someone?
105.
105? Someone to confirm? Yes. Okay, so let's solve this one here. So my CF, as soon as the interest rate don't change, is going to be equal to C0, 1 plus n times IS. Do you agree? So if I replace the values, this is 100. 1 plus n corresponds to 5 periods. The interest rate simple, that is the same, 0.01. So this is basically 1.05 multiplied by this one here. So your CF equals 105. Perfect. Answers about the second one? Someone?
$109.
I have 109. Guys, we always use 2 decimals, okay? I don't think we have decimals here, but we always use 2 decimals. Okay, round to second decimal. 109. Someone to confirm?
Yes, 109.
Okay, confirm. So let's do it. I have my CF. In this case, I have different interest rates, so they're going to be changed. So remember, this is going to be simply 1 plus N1 I1, simple one. How many different I have? 1, 2, only 2, right? Plus N2 IS2. So Y2 because I have 1 and 2. So my CF is 100. 1 plus, how many times do I have 0.01? 1, 2, 3. Sorry, I need to do this. What I'm doing. How many times 0.2? This one. Oh, also 3 times. So I have 6 plus 3, 9, 1.09 multiplied by this one here equals 109. Everyone is agreeing. This is very simple. Make sense? Excellent. So now let's go to the last one. Someone can give me an answer? Someone? You can do this in an easy way. You do one by one. Assume that this 100 is the only one. You can move it to the end, this 200 to the end, this 50 to the end. Got it? Remember, guys, we need to be efficient and you need to find the ways of solving the problems. Got it? 2 minutes to solve this one here. Just do the easy way. Assume that you only have 100. You move it to how many periods we have? Just to be sure, it's 1, 2, 3, 4, 5, 6, 7, 8. 8 periods. Then you move the 108 periods, the 205 periods, the 52 periods, and then we can do in a different way. Two more minutes to solve this. One more minute, guys. Ready? Some answers? Guys, answers here. Someone?
386.
386. Someone to confirm?
I got 387.
Okay. Yeah, perhaps the rounding. Okay. Another answer, or someone supports some of these numbers.
386.
Okay, so I have 2 here. Okay, so let's do this. Just to play safe. I will do the long way, okay, guys? So if I do the long way, this one here is simply what we have done here, correct? In example 2 is 100. 1 plus, I have 1%, I have 1, 2, 3. 3 times 0.01 plus 2%, I have 1, 2, 3, 4. 4 times 2%, and I have 1 time 3%. So I have here what is 8 plus 3, 11 plus 3, 14, right? This is 1.14. Am I right? It's 14, so this is 114. Guys, I need your help. Calculators here. 8, 3, and 3, see 14. Agree with me, guys?
Yes.
Okay, so let's do that 200. I need your help, guys, otherwise we're going to move very slowly. So this is going to be 200 times 1 plus 1% is 1 times 1%. 1, 2, 3, 3 times 2%, and 1 time 3%. 3%. So this equals what is 6, 7, 8. Correct? So this is equal to 216. And the final number is going to be 51 plus 0.03 plus 0.01. So this is basically 50 times 1.04. So I get 52. And then finally, you simply sum all these numbers here, plus 216 plus 114. Guys, do you get this with me, or I made a mistake? We need to verify. 103, 101, 101, 103, 123, 6, 7, 9. Oh, perhaps here is wrong. Guys, I need your calculators. Okay, I don't have a calculator with me. Well, I can use a computer, of course. So you have 3, 6 is 9. What do I have here? 6 plus 3, 9, 10. Oh, it's 10. So this is 200 times 1.1. So this is 220. So 220 plus 52 plus 114. Yeah, 386. I get this number, guys. Someone, I think that majority rule works. So this should be this number, 386. Do you have questions? Guys, do you have questions? Come on, guys, you need to interact with me. Otherwise, I don't know if I'm talking just to me. Guys.
I don't have any questions.
No questions. Okay, perfect. So, guys, I need you to participate in the class. Remember, that's why I do some class participation. I need you to be interacting and helping me with the numbers and just collaborating with the class. Otherwise, we're not going to be moving too far. Got it? Okay, so now let's do something more. Time transformations. Let's do time transformations. With a simple interest rate, guys, it's very simple. Okay, that's why it's called simple interest rate. So imagine if you have 12% that is valid for 12 months, what is the interest rate valid for 1 month? Do you remember this rule? I don't know how do you call this in English, but it's simply the X rule. So my X, so what I mean, my interest for 1 month, simple, is going to be simply equal to 12% divided by 12 multiplied by 1. So this is month, you cancel out, and then you get your 1%. Got it? So for example, what is my interest rate for 3 months? As soon as I have amounts, and this is an annual rate, this is going to be 12% divided by 12 multiplied by 3. So this is equal 3%. What is, for example, my interest rate simple for 15 days? Okay, here we go in a couple of conventions. So we have the following conventions, guys. Convention number 1 is that 1 year equals 360 days. Okay, and the second convention, 1 month equals 30 days. Okay, we're going to use this convention just to make our lives simpler. Later, we are going to relax this convention or use exact number of days. So what is my simple 15 days? Well, this 12% now corresponds to how many days? I need the 15 days. And if I have days here, what I need to have down is 360 days. And then I should obtain what? Let me, 12 divided by 360 times 15. So what I have here is 0.5%. Okay, let's do a couple of examples. So assume, guys, that I have the simple for 1 year equals, let's say, 15%. I want you to find what is my simple 1 month, what is my simple 6 months, what is my simple 10 days, and what is my simple 2 years. Okay, can you please compute this one here? Oh, no, no. Of course, I want to change this stuff here. These ones here are amounts, okay? Two more minutes, guys, to solve this.
Prof,
Yes.
I do have a question. If you go back to your previous example, previous exercise,
Yeah.
you said there was a long way and a short way. Did
Yes.
you do the short way? Did I miss that?
No. Yeah, we can do this. Yes. Let's do this later once you finish this one.
Okay.
Yeah, there is another way that is exactly the same.
Okay.
Yeah. Okay, guys, tell me sorry. The first one, the simple 1 month should be equal to what? Should be simply 15% divided by 12 times 1, correct, guys? So what do you get here?
Yeah.
What do you get here?
1.25%.
1.25%, perfect. The 6 months should be 15 divided by 12 times 6, correct?
Yes,
So this is equal to what?
7.5%.
7.5%, excellent. And 10 days. So here we need to be careful only with the units. So I need to divide this by 360 and multiply this by 10, correct? So what do you get?
0.42%.
Someone to confirm?
0.42%.
Yes.
Perfect, excellent. And 2 years, well, in this case, is 15 corresponds to 1 year, and I need this for 2 years. So my answer is going to be 30%. Make sense? Very easy. The time transformation with simple interest rates is indeed simple. So that's why the name is simple. Okay, have you done this exercise?
No.
Okay, so let's do the long way and short way. I will show you how to do that. Now, guys, in here, if I want to transform this one into, I want to find the rates per month. Okay, so if I know that this is for 3 months, what is the rate for 1 month? It's 3 divided by 3 multiplied by 1. So this is equivalent to 1% per period. Do you agree, guys?
Please repeat, Prof.
Yes. So remember that I have here the rate that is for 3 months. It's 3%. So
Yes.
knowing this one here, what is my simple for 1 month? It's like this exercise is here. It's going to be 3% divided by 3 months multiplied by 1. Do you agree?
Yes.
Okay, and so this is 3, this is 1%. So this implies that each period we have 1%.
Got you.
Okay, so the rate for this 1, 2, 3, 4, 5, 6 for these 5 months is given to you in terms of a yearly rate. And I want monthly rate, so I simply transform this one. So the 1 month, simple 1 month, should be equal to 15, corresponds to 12 months multiplied by 1, correct? Because I want the monthly periods. So this is going to be equal to 125, correct? Per period. So this is 125, 125, 125, 125, 125. And the last one here, guys, if I have the 6 months, the simple 1 month is going to be 9 divided by 6, correct? This is 1.5, 1.5%, 1.5%. And that's it. And then you see that you have transformed the rates now. So now you can use you can do something similar to this one here, Can you help me doing that? I will be copying the numbers and then you tell me, you help me. Now I will use this example to do other way, okay? So let's do this. How many times? 1, 2, 3, 3 times.
0.01.
Yep, perfect. Plus 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. 5 times 0.0125, correct? And plus 2 times 0.015. And you help me, guys, to compute. I will put the formulas and you help me compute these numbers, and then we can go further. So this is going to be 150. That multiplies 1 plus 5 times 0.0125 plus 2 times 2 times 0.0125 plus 2 times 0.015. And this one here is going to be 200 times 1 plus, it's only one period, 0.015. You can help me, guys, please.
Prof, just to confirm, is there 10 periods or 11 periods?
There are 11 periods, 11 months.
11 months.
Yes, so I have, this is the first, the second, the third, the fourth, 5, 6, 7, 8, 9, 10, 11. Yes, 11.
Doesn't that mean there's another 1.5 there at the end?
Oh, don't tell me. You're completely right. So we have a dot here, I forgot. Yes, you're completely right. So there is another 1.5% here, guys. So indeed, I need to modify. This one should be 3. Right? Plus 3 times this number. Also, this number should be 3. I'm just modifying this here. This number should be 3. And this number should be 2. 2 times this number here. Do you agree, guys? Do you understand? Let me delete this one just to be sure that we all have correct numbers. 1 plus 2 times 0.015. Yes, thank you. That was a good call. Guys, I need your help, please. Let's compute these numbers, okay?
Professor,
Yes. Solved.
I got 112.25 for the first one. I don't know if it's
Wait,
correct
wait,
or
wait, wait.
not.
Yeah, wait. Let's do this. Where's my pen? Here. So you get what? 100?
112.25, but I'm not sure
Yeah.
if that's.
Guys, someone to confirm?
I get something
I
else.
get 113.75.
Mm,
Oh, no.
I also
Yes.
get 113.75.
Okay,
Yeah.
so let me delete this one here. So majority rule, I need to confirm, of course, with you guys. So you said
113.75.
3.75.
75. Someone to confirm. One.
Yeah.
You can confirm. Okay, good. Do you agree, guys?
Yeah.
Okay, perfect. What about the second one?
166.125.
125. Someone to confirm?
Yes, I get the same.
Perfect. Yep. Another one, this one?
53.50.
Yes.
50. Okay, good. And the last one?
209.
209. Then if you sum all of these ones here, yep.
542.375.
375. Someone to confirm? Guys, someone to confirm?
Yep, got that.
Perfect. Excellent. Okay.
So is there a short way, Prof?
Yes. Well, it's not so short, but it's a different method. Let's do this. The other method, guys, comes from the principle of simple interest rates. Simple interest rates compute interest, don't pay interest over interest. Do you agree? So that's the main thing. So the second method, guys, is basically first compute interest. Okay. Not the interest rate, the interest. Okay, so how this works. So let's take a look to 100. What is the interest of the 100, guys? For up to 150. So it's going to be 100 times. When I use 1, what I'm doing is I'm adding the principal. Do you agree? If I don't add 1, I'm computing the interest, correct, guys? Make sense?
Yeah.
Yes.
Yes. So this is going to be 100. I just want to compute the interest. It's going to be times 3 times 0.01. Just I'm moving this into 150. So this is from here to here. Agree? So this is the interest of the first period.
Yes.
Okay. So now what I do is I add up these amounts. 100 plus 150. So I have 250 now. And I will move this 250 from here up to here. So I need to multiply this 250 times. So only the interest is going to be 1, 2, 3. Oh, 3 again. 3 times 0.0125. So this is the interest that corresponds to this capital for this period. Okay, now what is next is I add up the 50. So I have now $300. And I need to move this up to this $200. So I multiply this times 1, 2, 3, 1. Oh, no, sorry. It's 1, 2. 2 times 0.0125 plus 1 time 0.015. And then finally, I add up everything. So I have 500 that multiplies 1, 2. 2 times 0.015. So that this goes to here. So the sum of interests equals something. And then you sum the principal, that is, or C0, call it, that is 500. And then you should obtain, I don't, well, this one here, no. This one here is going to be 500. So the total should be 542.5 375. Can you verify that? So this one here, give me this number first. So this number equals, this number equals, this number equals, this number equals. Well, the first one is easy. It's going to be 3, right? Two minutes, guys, to do this, and then we can continue. Okay, guys.
Professor?
Yeah.
Sorry, I actually have a question.
Yes, go ahead.
So why don't we add the 3 into 250 and do the calculation? Because by the end of
yes, I understand. You know what? Let's go back to the definition here. This is the nature of the simple interest rate. The simple interest rate pays no interest over interest. Okay? So what you are telling to me is that this interest should also create interest. Is 3? If we add this 3 on top of the $100 that we have, so this implies that we are saying that interest paid interest. Do you agree? And the nature of the simple interest rate is that it doesn't pay interest on interest. So if you deposit $100, this is going to be computed forever, the base for the interest rate, not what you are creating in between. Right? So that's why here, this 250 indeed is the $100 base plus my 150. You see, I'm not considering the interest. The interest, I compute the interest, remove the interest to the side. Then I have a new principal, compute the interest, remove the interest, and put the interest aside. That's not the nature of the simple interest rate. Got it?
Gotcha. Thank you.
Pleasure. Okay, guys, you need to help me. So what do you get here?
Prof, I don't get the 42.375. Yeah, which means that there might be a mistake in either. So.
Oh, you didn't get this one?
I didn't get that one. Yeah, I got. Yeah.
Okay, so let's.
I think, sorry, where it says 209, in red where it's written 209, I think that's supposed to be 206.
Which one?
If you just go to the previous method that we were doing, the last sort of column, where it's 209, it should be 206.
Oh, someone can verify this one here, guys, because it changes. Can you verify this number here? So basically, we're saying 3 less, right? So this should be 39 there then.
Yeah.
Can you verify that? Okay, let me verify. This is easy. This is 1 plus 2 times 0.0 0.15.
Yeah, it's 200.
Yeah, it's 206.
Yeah.
Okay, so hopefully this is the only mistake. So this should be 39.
Yeah.
Yes.
Yeah.
Perfect.
Now it works.
539. Oh, sorry, this one then should be. This is good that we do this together, guys, because if you replicate this example, you know exactly what is the answer. So okay. Now, this one. So my C0 was 500. If I have this, I need to have 539.375. Okay, so this number should be then 39.375, correct?
Yeah. Yes.
So what do you get here? Can you, just to be sure that everyone has the same number?
9.375.
Yep, perfect. Another one?
12.
12.
Sharp, 12?
Yep.
Okay, perfect. And this one?
15.
15, perfect. And then we get the same number. You agree? And this method here, guys, simply tells you indeed that the simple interest rate never computes interest over interest. The interests are removed from the equation. They don't create new interests, etc. Got it? And that's it. Now, guys, this one here, it is very interesting, guys. In USA, we don't use, even 3 years ago, we were using this simple interest rate for computing the coupon rates for bonds. Now we have eliminated that. Now everything that we use is compounded. Okay. However, I do a lot of research on microfinance, and on microfinance, guys, the people still use simple interest rate. What is the argument? Well, it is simple. It is very simple to explain. You know what? If it's 12% in a year, 6% in 6 months, 1% in 1 month. Do you agree? It's extremely simple to explain and extremely simple to apply. Now, I will show you tricks in which you can make more money with a simple than a compounded. Okay, and that's what is coming soon. Make sense to you guys? Do you understand what is the simple interest rate? How the simple interest rate works? It's very simple. Okay, so now let's go and move to something that is used a lot, and we're going to use this one here all the time. Is a compounding interest rate. Okay, so what is compounding interest rate? Interest pay interest. Got it? So that's the basic concept here. Okay, let's do again my graph. I will do something like that. I will do this bigger. And I want to compute again CF. So this is period 1, no 0, sorry. I have my C0 and periods. And now follow me for a minute, guys. What is the interest that this C0 is going to create in the future at period 1? my interest is going to be the same. So I will call this I, okay? When there is no IS, I refer to compounded interest rate. So my interest is going to be C0 times I. Agree with me? So as soon as I'm compounding, I'm simply adding my interest to my principal. So my new principal for next period is going to be C0 times I. So this is equal to C0, 1 plus I. So this is the amount of money I have at the end of period, the beginning of period 1, that I will invest for period 2. Agree with me? Now, what is my interest at period 2? Is my new principal, is this one here, C0, 1 plus I, that multiplies I. So this is the concept of compounding. You see that? Now the interest that I create in the previous period is added to my principal, and all this new principal creates interest. So what is the new principal that I will have at the end of period 2 is going to be what I had at the beginning, C0, 1 plus I, plus my interest of the period, plus C0, 1 plus I times I, common factor, C0, 1 plus I, that multiplies 1 plus I. So at the end of the day, this is equal to C0, 1 plus I squared. Correct? Guys, you agree? Now, of course, if you do this n times, what is going to be the CF? My CF is, guys, is going to be equal to C0, 1 plus I to the power n. Got it? Normally, guys, we don't use CF in economics or in finance. Instead of CF, we call future value equals present value 1 plus I to the n. So this is, we are using simply different names. And also, guys, you normally don't see this equation in terms of future value here. What you can rewrite this one here. I'm rewriting this one here in very simple algebra. PV equals future value 1 plus I to the n. Oopsie. Agree? I is known as the discount rate, and 1 over 1 plus I, so it's called discount factor. Yes, naming conventions. Got it? 1 minute to copy, and then we can do exercises. Ready? Perfect. So let's go to some exercises here. Simple ones, and then we complicate our lives. So let's do example 1. An easy one. So I have my 100. I have 1, 2, 3, 4 periods. And I want to know my CF. And assume that my interest for all the periods equals 2%. Okay. So this is compounded rate. Okay, 3 minutes. No, se hecho pipí ahí en la toalla, se hecho pipí. Ujú. But ready? So the first one should be a piece of cake, right? So what is your answer, guys? CF equals what?
I got 108.24.
108.24, someone?
Yep.
Yes.
Yes, okay, so let's do this just to be sure. So this is a very simple, CF is going to be my 100 times 1 plus 0.02 to the power 1, 2, 3, 4, right? So your CF should be equal to 108.24. Okay, easy. Now here, what you see, guys, is that there is change of interest rates. All right. So what we do in this case is simply 100, 1 plus, because I want to have the final value, 0.01. How many times it happens? 2 times. Times 1.02. How many times? 1, 2, 3. Times 101 to the power 1. Agree with me, guys? Okay. So what do you get here? Someone?
109.33.
Okay. Someone to confirm?
$109.33.
Perfect. Okay. So we arrived to the same conclusion. Make sense, guys? You understand how the compounding works? Let's do this this example here. Anyone has an answer here? Someone?
Yeah.
Yep. What number do you get?
361.64.
361.64. Someone?
Yeah.
Good. Someone else?
361.65.
Yeah,
Yeah,
that's
rounded.
close enough.
Yeah.
Yeah, close enough. Okay, so let's do this. I will do the long way, okay? And the short way is indeed a short way, but let's do the long way. Okay, and why I do the long way, guys, because sometimes you get confused. Forget about that. Do as you want. Okay, so later you want to understand the logic. At this in this class, as soon as we're time pressure, guys, solve it as you are able to solve it. Okay, something that is easier for you, do it. I don't correct the process. I just want to see that you arrive to the correct conclusion. Okay, so if I do my 100, I will do the same as before. So if I move this money to the future, it's going to be 100 times 1.01 to the power 1, 2, 3, 4, 4 times 1.2 to the power 2 times 1.3 to the power 2, correct? This one here is going to be 150 times 1.1 times 1.2 power 2 times 1.3 power 2. And this last guy is going to be simply 75 times 1.03 to the power 2. Make sense to everyone? If you can help me with the numbers, please. Someone?
114.86.
This one?
Yeah.
Okay, someone to
Yes.
confirm? Yeah,
Yes.
perfect.
Yes.
Yeah, excellent. The second one? Someone?
165.56.
Okay, someone to confirm?
I got 167.2, but let me do this again.
Yeah,
can
I
you
also
please-
I
got
also
the
get
second.
one.
Yes.
167.2? Yep,
Yes.
okay. Perfect, and the last one?
79.57.
79.57.
57.
Someone to confirm?
Yep.
Perfect. And if you sum all these numbers, what do you get?
$361.65.
Yeah, perfect. So you know the rounding is okay. Makes sense to everyone, guys. Now, do you understand this method? Now let's do the quick method. Can you copy and then let's do this together? The next method, let's do this together so you can understand. Copy and then you tell me. Ready, guys?
Yeah.
Yep. Okay. So let's do this. The method that shows basically that interest make interest. Okay. So let's do the 100 as before. I move the 100 guys up to the 150. So if I move this 100 up to here, it's going to be simply 100 times 1.01 power 123. 123. Correct. So this is the value of 100 at this period here. Agree with me?
Yes.
Then, by logic, the compounding rate implies that now this is my new capital at period 3. I can add then the 150, then that is my new money. So this is my new capital up to in period 3. And then I move all this money up to period 6. To do that, I simply multiply this one here times 1.01 times 1.02 squared. Agree with me, guys? So this money here is my new capital up to period 6. So I can add up here 75. So this is going to be my new capital at period 6. And then I simply move this one here 2 periods ahead, multiplying 1.03 to the power 2. And this is my final value. You see, here is where you can see the compounding property. This includes principal plus interest. The next period is the new principal plus interest. Then I add my new principal, and then I finally multiply by my interest. And then I have my complete number. Can someone please verify that we obtain this number here? If we haven't made a mistake, we should arrive to the same number.
Yeah, I did it like that.
Perfect. So you get your 361.65. And then this is short. Do you agree? Now it's in a single line you do instead of doing this one by one. It's not short. The simple one was not short, but this one is really a single line. Okay, copy 1 minute, and then we do time transformations. Ready?
Yes.
Perfect. So now let's go to time transformations. Okay, so now time transformations refer to compounding interest rates. It's a little more complex, but it's not difficult. So let's understand the following. Imagine, guys, that we have C0 and you have CF. Okay, and my rate from here to here equals I1. Okay, so all the rate is I1. And then what I will do is I will divide this into small pieces equal size. And I will call each of these ones here I2. Okay, all of them compounded. Now, what is the formula for I1, guys? So the interest rate for the full period, if I give you C0 and CF, is going to be equal to what? What is the interest rate for the period? Guys, if this is 100 and this is 110, what is my interest rate for one period, for the complete period? Guys, 10%. That's basically, that's what I'm telling you guys. I don't know why the people get confused. It's a simple interest rate, never changes. It's future value minus present value divided by present value. This is my equation for I1. If I1 is a single rate for the full period, this is my formula, correct? Yep. Now, I want to use CF, I want to use I2. So CF equals what using using I2? It's going to be a future value of C0, 1 plus I2 to the power n. Do you agree with me or not, guys? CF, so this value here, this is my formula. If this rate repeats every single time, n times, it's going to be C0 times 1 plus I2 to the power n. So this is number 2. And I will do is number 1 in 2, number 2 in 1. So I1 equals C0, 1 plus I to the n minus C0 over C0. If I simplify, C0 goes away. Finally, I1 equals 1 plus, so this one is I2. This I2, yeah, I2 to the power n. This n is the only one that is kind of tricky. This n, guys, is a ratio. Okay, so let me write this n. This n here is going to be a ratio. Okay, so n is going to be periods of I1 divided by periods of I2. Sorry, this is I1 divided by periods of I2. Okay, so just to remember, guys, n denominator goes for this guy, and numerator goes for this guy. All right, just to remember. All right, let's do a couple of examples. You will see how simple this works. Okay, so let's do one example. Imagine, guys, that I have my company interest rate equals 10% for 1 year. My question is going to be, for example, what is my interest rate, compounded interest rate for 1 month? Okay, so what we need to do is we need to transform this into 1 plus 0.10, 0.1, to the power of something minus 1. So this is going to be my rate. So what I write down, first down, this rate corresponds to how many periods? Remember, if I want months, I need to use months. So this is going to be 12, and the period here is going to be 1. Do you agree with me, guys? This is what my arrows mean. The numerator goes the time dimension of this one here, and the denominator goes the time dimension of this one here. Make sense to you guys?
Yeah.
Yes, and then can you please provide me, compute this number, that the people used to have issues computing this number, is 1.1 to the power 1 divided by 12 minus 1. Can you give me this number? And then you compute these other rates. Here I obtain guys from South Africa, please don't forget to tell Mandisi and Ujisani to be in the class. I see that Sele, you're here in class. Welcome to the class, okay? If you can please let Ujisani and Mandisi that the class is going to start at 5 p.m. now. So 1 hour before for you, for our friends from South Africa. Got it? Okay, can you give me this number? What do we get here?
I got 0.00797.
Yeah. Do you agree with this number?
Yes.
And if you want to put this in percentage terms, so this is going to be basically 0.797%. Okay, perfect. So this is going to be, and then you help me with the numbers. To the power of something minus 1. This is going to be 1.1. I write this directly already. To the power of something minus 1. 1.1 to the power of something minus 1. So what is this something? What I write up? Numerator, guys. What I write in the numerator?
$360.
Numerator. So remember,
No.
yeah,
Sorry,
always
sorry.
the up is 15. Okay, so remember this just to remember, this goes up, this goes down. Okay, so down is going to be 360 because this rate here corresponds to 1 year. So 1 year by convention is 360. Correct? Guys, make sense to everyone? Okay, what about the 6 months? What goes up?
The 6.
6 and down?
12.
12. Because this is months, they cancel out, etc. So what about 2 years? What goes up? Guys, come on. 2 years and down 1 year. Do you agree? Etc. Okay, so very quickly, guys, and with this we stop. I just need to be sure that you get these numbers. So I will try to do 1.1 power 2 minus 1. So this is 21%. Year 1 is 1.1 to the power 0.5 minus 1. So this one here is 4.88%. Please you verify this later. 1.1 to the power 15 divided by 360 minus 1 times 100. So this one here is going to be 0.3979%, etc. Make sense to you guys? Do you understand these time transformations?
Yes.
Okay, perfect. So next class, what we're going to be doing is we're going to finish compounding. We're going to see the relationship between compounding and simple, and we're going to see that all the tricks that we're going to find using the simple interest rates. Got it? Make sense? So just to remember you guys, next class, so next Thursday, we start at 5 p.m. East time, so 11 p.m. South Africa time. So we just start 1 hour before. So we can accommodate better our friends from South Africa. Make sense to everyone? Okay.
You mean this Thursday, right?
Yes, we start from this Thursday and all the
5 p.m.
remaining classes. Got it. And remember, guys, just for those of you who were not present during the first part of the class, I will provide you 2 Fridays. You're going to receive 1 hour, 1.5 hours video that you need to review, check, do exercises, and then next class, the first 15 minutes, we simply go review and then we move. Got it? So with you guys, we finish basically 1 class before the normal regular time. Got it? Make sense? Okay, guys, have a good night and see you on Thursday. If you have questions, just email me and then we can start talking and discussing, etc.
Thank you.
Before you
Yeah.
go,
Yes.
just something from our side. We're
Yes.
having these last minute, sometimes load shedding. We have a power crisis, so I'm assuming maybe it could have been the challenge for the other colleagues. I don't know, but I'm
Yes.
just putting it out there just to
No problem. No problem.
make
You
you
know,
aware
guys,
that.
perfect. You know what, please try to be in class. You know, I need your help because I need you to complete this one. And it's also very important for you guys to be here because by doing the exercises, you learn. There is no better way of learning by doing. Seriously, guys, you know, by experience, I'm telling you that. Got it? So if you are not able to be in class, remember this class, the recording of this class is going to be posted in YouTube, you know, perhaps in 5 days. I'm not sure. I will press for publishing this quicker. Got it?
Yeah,
Yeah,
I was
yes.
going to ask, is there any way you can shorten that time from your end?
Yeah, I will ask. Because what I do is Fordham the one that helped me to do that. So it's Fordham the one that controls that. And I don't know how many summer classes they have and how many summer classes they're going to publish, but I will push. Don't worry. Yeah.
Yeah.
Okay?
The shorter the better. Yeah. All right.
Yeah.
Thank you.
No, I understand. Definitely. I understand that. Okay. I will push hard for that. Okay, guys. See you soon then. See you on Thursday. Bye-bye, guys. Take care.
Yeah.
See you.
Thank you.
Bye-bye.
Bye.
Bye. Bye.
Bye.
Bye. Good night.